you joining us for this webinar today. We've got an expert speaker who's going to dive into the detail of his report, which is so critical and important for our country of Aotearoa, New Zealand. We're here to talk about one of my favourite topics, which is taxes. And as you know, there's a well-known saying, nothing is certain in life except death and taxes. But I wonder for some in society that might not be true anymore. We see reports such as the UK-based FAR Tax Foundation looking at the big US tech companies, the so-called Silicon Six, have paid 470 billion less corporate income tax in the last decade compared with US companies making the same profit. This is a time when we see the billionaire leaders of some of those companies jet off to space, speak at far-right rallies, and slash US government spending. And thanks to the research that's been undertaken in New Zealand, we now get to have a look at the New Zealand situation. I'm Gareth Hughes. I'll be in conversation with Nick Miller today. I'm the Director of the Wellbeing Economy Alliance Aotearoa. We're a think and do tank with a mission to reshape the economy so it's in service to people and planet. So often it feels like it's people and planet in service to the economy. I've spent 25 years trying to make a better world using multiple tools from governance to politics to activism to judicial challenges. And I'm convinced that it's the economic system, if we can get that right, we can deal with some of those persistent challenges like child poverty, inequality, climate change. We're a proud member of the Better Taxes for a Better Future campaign, calling to promote discussion about a better tax system for Aotearoa, calling on the public, businesses, NGOs, politicians to think again about what tax means. We're an alliance of multiple organisations, including WEAll Aotearoa, Action Station, Air2, Salvation Army, and many other organisations caring deeply about the public interest and the public good for Aotearoa. We believe in the face of deep systemic challenges such as poverty, hardship, inequality, overstretched public services, environmental degradation, taxes are a powerful lever for the public good to build a better future. Tax is what we do together to build that future. So today we're here to dive into one particular area where Aotearoa can improve. We're here to talk about the recently released Big Tax, Little Tax report written by Nick Miller. The report was conceived following the recent demise of the digital services tax, so it's a timely intervention. It's a great privilege to introduce Nick, the lead author of the report, who's going to give about a 20-minute presentation into the report. Then we'll have an opportunity for questions. Please do send your questions in the chat. I'll maybe ask a few as well, but we'd love to get your questions, so please put those in the chat. To introduce Nick, Nick's a tax practitioner with over 30 years of experience, mostly in the public sector. Most of his career has been in the UK Inland Revenue Department and later the HMRC. He trained as a tax inspector, then worked in the International Division, the Special Compliance Office, investigating high net worth individuals and offshore companies, the Large Business Service Unit, and the Strategic Risk Unit. From 2002 to 2004, Nick took a leave of absence to work in New Zealand's IRD department, where he took a leading role in the investigation of structured finance tax planning in the banking sector, which eventually led to one of the largest settlements in New Zealand's history. After a 4-year spell at Ernst & Young, he returned to Aotearoa in 2013, where he played a leading role in developing transfer pricing expertise in New Zealand. He then had a bit of a sabbatical and now works on contracts and recently joined the UNDP's roster of experts to support the work of tax inspectors without borders. We're really privileged to have your expertise in New Zealand, Nick, and the work you've done. I'd love to pass over the floor to you now for your presentation. Kia ora koutou.
Thank you, Gareth. Kia ora koutou. I'm just going to share my screen so we can look at the presentation. So this is going to be a brief run through the main points from the report. I'd certainly encourage people to read it if you get a chance. There's a lot more additional detail and explanations. But if we start with the big picture, Sorry, slight technical malfunction there. We're going to have a brief run through the report, looking at what is the problem we're talking about. What are the tax minimization techniques used by the companies, the tech companies that we're talking about, and most importantly, what we can do about it, and why we should do something about it. So looking at the big picture, the global picture, these groups are very, very profitable. You can see that from the table, which is reproduced from the report. And the reason they're very profitable is largely because of the nature of the business they're in. They don't have to spend a lot of money on raw materials. They don't have to invest in big manufacturing plants. What they do is spend a lot of money on research and development. They spend, well, Google spends about 15%, Facebook, for example, up to 25%, maybe a bit more on research and development. So that creates valuable intellectual property, which is driving their business, whether that be software, cloud services, or digital content. But that doesn't translate into big returns in the countries in which they operate. And that is true not only of New Zealand, Aotearoa, but many other countries as well. But looking here at what happens in New Zealand, you can see that the 30 to 40% returns actually become 0 to 5%, resulting in very little tax being paid. I think less than 20 million overall by these 5 companies, for example. And what we're going to look at now is how that comes about, what these companies do to minimize the amount of taxable income they leave in New Zealand, Aotearoa, and other countries, so that very little tax gets paid here. And there are 3 techniques, and we're going to talk about each of them very briefly: the service fee model, the inflated license fee, and the service company model. Taking the service fee model first, in many ways, it's the most egregious of them because it's so blatant. The local New Zealand subsidiary pays what is called a service fee to an offshore affiliate, not usually its parent company, but a member of the same group. And this fee is so large that it leaves very little income here. When I say large, in a couple of cases, in the case of Google and Facebook, it's over 90% of all the revenues they earn in New Zealand. And our point is that some or all of this so-called service fee could be a royalty, could be a payment for the use of intellectual property in order to earn revenues in New Zealand. And we'll come on a little bit later to discuss what that actually means in terms of challenging these arrangements. But the next slide illustrates the extent of the problem in terms of how much is being shifted out of New Zealand. I mean, you can look at those numbers. It's over 90%, and that still leaves these companies to bear their local expenses. So they still have to they still have deductions for employee costs, for example, as well as paying this astronomical service fee away to an offshore affiliate. Amazon Web Services is a little bit smaller than than Facebook and Google, who also use this technique, but it still doesn't leave very much in Amazon Web Services because they have a very large employee wage bill. And you might ask yourself, what are those people doing? What are they doing in terms of producing value, given that Amazon Web Services earns no taxable income or leaves no taxable income in New Zealand? So, I mean, that's a conundrum. Facebook is also interesting because its revenue total in New Zealand is actually far less than one might expect, given that globally Facebook has about 50% of the revenues of Google, for example, but in New Zealand it's only 15%. So I might be looking more into that as we go along. And the next technique is what we call the inflated software license fee, and this is more beloved of the more established software companies. I'm talking the Microsofts and Googles of this world in particular. And how this works, it's not that different from the service fee um, the service fee technique, because it also involves a shifting of a large amount of New Zealand revenue offshore, but this is in the form of a license fee, a software license fee to an offshore affiliate. And these payments are also very large, like the service fee, and leave a very small amount of income here. Um, Now, one of the issues is that we have to look at is it a royalty, the same as the service fee? And Oracle, for example, describe it as a software license fee, whereas Microsoft described the payment out as software purchases. But if the payment, for example, is for the right to distribute or make available to the public copyrighted software, then it's likely to be a royalty, and therefore, again, potentially subject to withholding tax. And like the service fee technique, we also need to look at the sheer size of the fee. I'll go on to explain why that's important in terms of whether or not it's excessive in the next couple of slides. So that's just another slide from the report, another table from the report showing how much is taken out of New Zealand. New Zealand revenues are shifted offshore. Now, again, both of these companies operating in New Zealand have quite big physical footprints as well. A lot of employees, a lot going on. So they have a lot of expenses here anyway, regardless of those payments offshore. So again, it leaves very little to be taxed in New Zealand. The final one is the service company model, and this is slightly different because the revenue never reaches New Zealand in the first place. It's all booked offshore, and what happens is that the New Zealand company is structured as a company providing basic services to an offshore affiliate and just earns a modest markup on its costs. And yeah, I mean that's simply another version of making sure that revenues, one way or another, don't end up being taxed in New Zealand. So why are we looking at here an extract from the financial statements of MasterCard in 2014, about 10 years ago? The reason is that um, MasterCard, one of the two major credit card companies, uses this technique, and up until 2014, they were forced to, or they were compelled under law to make public their financial statements. You could see them in the company's office. But after that date, if they were returning, if they had revenues of less than $11 million, then they did not have to make those financial statements public. So we can sort of deduce from that that's their revenues are still below $11 million. That's their, as a service company, that's all they're earning in New Zealand. I mean, that's their revenues as well, not their taxable profit. And when you consider that the amount of card transactions in New Zealand now is around 49-50 billion dollars a year. That's credit card transactions, doesn't include payway, for which they also take a cut. You might think that returning 11 million worth of revenue in, or less than that in New Zealand, is somewhat questionable, if I can put it like that. So basically, all these three techniques shift large amounts of revenue earned in New Zealand out of the country. But both our domestic law and the law as amended by our double taxation treaties permit taxation of royalties by the source country, that is the country paying the royalties. And we can do that under domestic law. We can withhold tax of 15%. That's it. That's uh, on any payment which is determined under the law to be a royalty. Most of our double taxation treaties reduce that rate, and the ones we're talking about here, mainly the treaty with the US, but also the treaty with Singapore, reduce that rate to 5%. So it's still 5% of the royalty. But if we're looking at some of the numbers we were looking at in the tables earlier, that 5% of a billion or so being paid out is still a very large number, and much larger than the amount of tax being paid on the company's profits, for example, as we saw in some of the tables earlier. And that 5% is only, or the 15% is only reduced to 5% to the extent that the payments are not excessive. Now, the double taxation treaty simply talks about it being excessive if it's by reason of a relationship, a group relationship. So, I mean, that's a matter of investigation as to whether payments are excessive, but it could mean that some of those royalty payments might be subject not to 5%, but to 15%. So that royalty, the ability to tax payments made offshore as royalties, certainly is relevant to the first of the first two of the tax minimization techniques that we were looking at. That is the service fee and the license fee, because they both involve payments being made offshore that probably, in part at least, are royalties. But the the third technique involves groups booking revenue offshore and setting up a New Zealand company, as we heard, as a service company. There is an obscure provision in the law that was introduced in 2018 to deal with this kind of scenario. And without going into any of the detail on this, if a New Zealand service company is actually facilitating sales and receives most of its income from doing that is as a service, its service fee, then the arrangement is, and the arrangement effectively reduces taxable income in New Zealand Aotearoa, which it clearly does because the offshore company doesn't pay tax here. Then the non-resident company, the company booking the income offshore, is treated as having a permanent establishment here to which sales are attributed. And that means that the starting point for discussing what sales are taxed here are the actual New Zealand revenues that the non-resident has booked. By permanent establishment, we mean it has a taxable presence here. It's deemed to have a taxable presence here. Now, that is pretty obscure legislation. It's for anyone interested in reading tax legislation. There may be a few of you who are. Then it's Section GB 54 of the Income Tax Act 2007. And I'm not sure whether it's ever been used. So that is another interesting thing to ponder around what we're doing about this. So Australia is interesting because they've been far more proactive about looking at these issues. They are currently in litigation with Oracle. Oracle say that their licensing fees are not royalties. Well, the Australian Tax Office disagrees, and we will find out who's right on that. And the Australians have also issued a lot of guidance on what they consider to be software royalties. They've also been involved recently in litigation on embedded royalties, that is, royalties which are part of a payment for something else, be it products or services. And they've also introduced other budgetary measures to deal with mischaracterization of royalties. That is the kind of things we're talking about, where you call something a service fee, but it's actually a royalty. And they are also much bigger than New Zealand on transparency and disclosure requirements. For example, they have introduced public country by country reporting that forces companies, multinational companies, to disclose quite a lot about their activities in certain territories. Now, the Australian version of this designates a lot of low tax and no tax jurisdictions as ones where they have to report individually on company activities. And they also have much more detailed disclosure requirements for related party transactions than we have in New Zealand. So our report contains some specific recommendations on increased transparency and disclosure. Certainly, we'd like to be more like Australia in terms of public by country reporting. We certainly don't want companies like MasterCard to be able not to declare their 11 million or less than $11 million revenues, and therefore that would be a rather simple change to the Companies Act to force them to provide publicly their financial statements again. And we think we should again be more like Australia in terms of disclosure requirements for related party transactions, have more granular detail. Inland Revenue has international questionnaires, but they're quite broad risk assessment techniques. They don't give you the granular detail that the Australian Tax Office requires about transactions with related parties. So why should we challenge this? We've sort of talked about how we can challenge it. But it's a lot of money. Potentially 150, 200 million, could be more, depending on what is deemed to be excessive, how much of these payments are royalties, all these kinds of things. It all needs investigation. I wouldn't say it's a simple fix, but there are existing laws. These are very long-standing international principles of source taxation. They can be used to challenge these arrangements, and they need to be tested before the courts. Otherwise, we don't know whether they're effective or not, or whether we need to do something else. And the most important thing is that doing nothing really undermines the whole integrity of the tax system. If other people see these groups getting away with these kind of practices, they might be encouraged to in other sectors, other taxpayers might be encouraged to adopt similar practices, and that would obviously lead to a loss of additional revenues and lead to a breakdown in trust, I think. So that is the end of the presentation. I do have some slides at the end, which I won't speak to now, but they contain some of the guidance and law that we're sort of relying on. I think it's important to know that that guidance and those laws actually exist. They're there in black and white, and they're to be used. So that's hopefully on time, a brief run through the The main points in the report. There's a lot more detail, as I mentioned, actually in the report itself, and definitely encourage you to read it. Thank you.
Oh, Nimihi, kia ora, Nick. That's excellent. And we're so lucky to have you doing this deep dive into the New Zealand situation. I see lots of people clapping their hands and acknowledging you in the chat. A few questions coming through as well, which I'm looking forward to asking you. Can I go right back to basics for someone who's, not particularly engaged with tax questions? How would you explain this to maybe a middle schooler, someone intermediate? Is there an analogy, maybe how a household, the equivalent would be, or is it just not possible to draw an equivalence with a small business or household because this we're talking about giant companies and international trade?
I think it is difficult to draw that kind of analogy because literally you probably wouldn't encounter this kind of situation outside of a group situation, a multinational group situation, um, simply because of the amount that's being shifted. Uh, I mean, the only possible comparator would be more out and out evasion, where somebody shifts revenue out of a business before it can be taxed. Um, I wouldn't put that in this category. I think it's yeah. I mean the adjective I used the other day was dodgy, and I think it is. It's very questionable whether it's evasion, whether it's avoidance. Is sort of in a way it's a moot point because it doesn't matter. We don't have to show that it's avoidance. What we just need to do is to use the existing law.
I understand. I had a similar question in my mind to Andrew Riddell. Can you explain the difference between royalty and service fee?
Um, Well, a royalty is defined in domestic legislation and in our double taxation treaties. So that's generally a payment for the right consideration for the payment, the right to use intellectual property of various descriptions. Could be copyright, could be patents, could be something much broader in terms of know-how. And the royalties have a very broad definition in both our domestic legislation and to a lesser extent in our double taxation treaties. So yeah, it's a payment. It's a payment for a right, whereas a service fee in general is a payment as you would expect for services. So one would assume if a payment is described as a service fee, then services are being provided. And if you take the example of Google, for example, that service fee is over $1 billion. Now, you would sort of, I would question whether the New Zealand business, Google New Zealand business, could use services that would cost $1 billion. Whereas uh, I would think they probably do need access to Google's intellectual property rights in order to be able to earn revenue in New Zealand. So yeah, I mean they are quite different, and calling it a service fee, I think is a mischaracterization.
Am I right? There's a tax advantage in turning what could be considered a royalty into a service fee.
Correct, there is, yes, because you for income tax purposes you can get a deduction for both. But a service fee is not subject to the withholding tax regime, the source taxation rules that I was talking about a few minutes ago. So that service fee would not be subject to a withholding tax of 5%, 15%, whatever it is. So there's a clear tax advantage in doing that.
Interesting. I was talking to international trade researcher Edward Miller recently, and he mentioned some companies were charging what he considered inflated royalties to their offshore parent as a way potentially to avoid tax. But it sounds like they probably wish they were a tech company and maybe could upgrade to a service fee rather than a royalty.
Well, they may well be still avoiding tax by having an inflated royalty. because if the royalty is inflated, that is not arm's length. It's higher than what you would see in an arm's length situation. Then potentially that's disallowable under transfer pricing rules, for example, if it's within a multinational group. So it could be disallowed, but obviously if it's a large if an inflated royalty has been paid anyway, regardless of whether it's disallowed under the transfer pricing rules, then it will be subject to withholding tax. So yeah, I mean, if you want to avoid all of those situations, then you call it a service fee.
Um, is this a uniquely limited to big technology companies, or are other sectors doing something similar?
Uh, it is largely a the service these particular service fee tax minimization techniques, I think, are mainly seen in the tech sector. Uh, what is a broader tax issue that affects a lot of other sectors, may be embedded royalties in general. That is part of the price for paid for products or services, actually a royalty, a payment for intellectual property rights. Now we saw that in the PepsiCo case in Australia, where um, the the I mean, this was not a group situation, but the Australian company bottling the drinks actually bought the concentrate from Pepsi, and the question was whether part of that payment for that concentrate was actually um, a payment for intellectual property rights. Now, I mean, that was a very close run decision in the Australian courts, but that sort of scenario could occur in other sectors as well. If, for example, say the New Zealand subsidiary was being given access to sort of brand IP, marketing rights, um, and that was worth something, and the payment for that might well be embedded in the price they pay for products that they import into New Zealand or services. So to that extent, it is broader than the tech sector, but you get these very extreme examples, I think, in mainly in the tech sector.
You mentioned Australia and some of the interventions and actions they've undertaken. Um, what was the catalyst for that in New Zealand? And are you detecting an interest of the New Zealand IRD or government to embark on similar initiatives?
I don't think so at the moment. I think that the Inland Revenue in New Zealand has been largely focusing on the digital services tax in the last few years, and from what I can see anyway, doesn't really seem to have a plan in policy terms to replace it. Now, maybe they don't need one, because what they need to do, arguably, is simply enforce the laws that we already have and not worry about the digital services tax, the laws that we were, the um, the source taxation rules that we were talking about earlier. So it may be less a question of whether they're going to do in policy terms, or whether they're going to do anything like Australia, or it may be simply should they be taking greater enforcement action.
Yeah, thank you. Kate asks a good question in the chat. How does this compare with what domestic businesses are paying in tax, i.e., the proportions of their revenue that is being taxed and the tax rates that apply?
Um, I mean, I don't have detailed um, numbers on that, but one thing we do know, and I think Inland Revenue have alluded to this themselves, is that domestic businesses tend to have greater returns on sales than we're seeing, the 0 to 5% we're seeing for the tech companies in New Zealand, um, and and so therefore it's self-evident there a greater proportion of their income, their revenue is being taxed. Absolutely no doubt about that. 0 to 5% is a small return on sales, even for a distribution company in New Zealand.
So, if I got this right, some of the world's largest and most profitable companies are getting a very low return on sales in New Zealand, which would indicate that perhaps they wouldn't be performing particularly well.
Well, they're certainly having a very low return on sales. 0 to 5% is, as I said, is very low. Yeah, I mean, if you looked at it in vanilla terms, you'd say, yeah, that looks odd. That's a poor business performance. But of course, as we know, the reality of it is that they are earning a great deal, billions and billions of dollars in New Zealand in revenue every year. And so what we can see is that there's simply a lack of transparency about how successful their business is in New Zealand because of the techniques that they've used.
We've seen a really, I think, quite effective statistic enter the public discourse, which was the IRD and Treasury's research into, I think, the 311 wealthiest families and paying an effective tax rate on wealth more than $270 million, less than half the rate of, teachers or nurses. Uh, However, we've recently seen the omnibus bill be released by the government last month by Revenue Minister Simon Watts, which is going to remove that section of law that gave IRD the power to request information for the purpose of tax policy development. Do you have any comment with your, 3 decades of experience in tax around that policy change we're seeing in New Zealand? And could this be a follow-up piece of research that perhaps for the tech sector we could work out what an effective tax rate for that sector is so we could compare against others?
Yeah. I think we could certainly see what the effective tax rate is and compare it with um, New Zealand companies in general, in particular sectors. Absolutely no doubt about that. I think also it's interesting that the sort of the the measure to get rid of this power is sort of almost the opposite of the sort of increased transparency we're seeing, for example, in Australia. And I also note that the ability to gather specific information on trusts is also being removed in the omnibus bill. So you have this sort of trend in Australia towards greater transparency, and apparently the opposite here.
I see a comment from Kushlan in the chat, which I'll read out. There was an article showing that New Zealand companies paid close to the corporate tax rate. The exception was retirement home companies, which book large capital gains on their property holdings. Um, a question from Eileen on a different tack. Her TSB account changed credit card from Visa to MasterCard with no discussion with them, the customers. Would that be to do with TSB taxes?
It's likely to be a result of negotiations between the bank and uh, the two companies. Occasionally, what happens with the credit cards, they tend to have a link with a bank for I don't know, a period, a contractual period, and then they might switch. That's a matter for negotiation. So what I would guess happened in that case is that yeah, there was the bank, or the bank may have had discussions with both credit card companies and decided uh, to go with the other one. And I mean, that's interesting from another point of view, because those discussions, a lot of those discussions would have taken place locally. And so that's in effect the so-called basic service company is actually negotiating this very important contract with uh, uh, with banks and possibly merchants as well, important merchants as well, because the the Mastercard payments were booked in the revenues were booked in Singapore. You can see that from their financial statements back in 2014. But those kind of conversations are likely to be mostly taking place locally rather than between a New Zealand bank and Singapore. So I mean that sort of um, scenario, yeah, brings out a lot of aspects about how the credit card companies operate here.
Thank you. Krishlan's asked a couple of questions, which is firstly, are you able to get information from IRD on sales and taxes paid in New Zealand for other multinationals? They refused their request, and Biden's government proposed to take away the right to transfer IP values out of the US to tax havens. Did that happen? And if so, are we likely to benefit?
Um, I think taking the first one, or no, taking the second one first. The US government's uh, measures on IP, I think removed some of the tax advantages that uh, US companies have for locating intellectual property rights in no tax jurisdictions, tax havens. That definitely did happen, but I don't think I think a lot of these groups have found their way around that by putting them in lower tax jurisdictions that maybe not or splitting intellectual property rights between various jurisdictions. Do I think New Zealand's going to benefit? Probably not, because if we were going to benefit, we probably would have seen some change already, and we haven't. So those those payments that we saw going out from, say, Google and Facebook, they're still going to Facebook. Payments are going to Ireland. Google payments probably going to Singapore. They're both lower tax jurisdictions still. Uh, sorry, you'd have to remind me of the first part of that again now.
I think that was requesting, give me 1 second. Um, were you able to get information from IRD on sales and taxes paid in New Zealand for other multinationals?
Uh, no, because that would be taxpayer confidential. If there's no obligation under the Companies Act to file publicly, then this would simply be taxpayer confidential. So I imagine any official information request for anything like that would simply be blocked on those grounds.
Mark asks a question looking at the GST component. He asks, I'm presuming service fees are GST levied and royalties are likely not GST levied. So wondering if the figures for GST returns are considered, as noted high costs such as leases would minimise GST revenue, i.e. the GST figures shown in your report is tax paid in New Zealand.
Well, these numbers are GST exclusive because that's the way they're presented in the financial statements. So we don't have visibility over exactly how they're treated for GST purposes. But one would assume that the service fees are subject to GST. But I don't have any visibility on that.
Marie asks a question looking what IRD is doing in far as investigating companies to determine whether they're correctly categorizing their expenses, uh, brackets not finishing their figures. Is IRD doing some of that investigations that you're aware of?
Um, I'm not aware of what they're doing, and I clearly going back to the taxpayer confidentiality issue. They're unlikely to disclose anything they're actually doing on the ground. Uh, I think there's probably a broader point here that Inland Revenue has been through quite a lot of upheaval over the last 7, 8 years. It's been through two restructurings. It's been through COVID, and it's lost a lot of its most experienced staff, uh, the kind of people who would maybe be best placed to investigate um, these sort of matters. Because if you're saying or if you want to investigate whether a payment's been recharacterized, a service fee is actually in reality a royalty, for example, then that involves a significant degree of investigation. As one of my old managers used to say, getting the drains up, and uh, that I mean that's not a an easy undertaking. It's something that needs to be done with the experienced staff. Now, if I were Inland Revenue, I'd be saying there's a lot of people in Australia, for example, and maybe working in the private sector in New Zealand who have that kind of experience that, could be brought in, um, to help upskill their present staff to enable them to do it.
If we had enough resourcing and enough capability within IRD, do we have the right legal regime to allow us to do the investigations to find that information, or would there need to be other potential law changes and powers given?
I don't think so because I think there are quite extensive information powers, particularly in regarding transfer pricing, which is probably where you'd start off with this is the payment excessive and then decide what part of it was a royalty. So there are quite extensive powers to ask for information, not only from the New Zealand subsidiary but also from their parent. So I don't think that part is lacking. I think it's there may be a degree of just being risk averse, of not wanting to make the necessary investment to take a case to litigation, because that's a significant investment of time, resources, etc. And you might not even get the result you want, but you have to at some stage test the law.
Yep. Maybe taking it out to the bigger question of what the public services we're missing out from tax evasion in New Zealand. Scott remembers seeing Lisa Marriott, Professor of Taxation at Victoria University, talking about 1 billion in tax evasion going on in New Zealand as an estimate, and perhaps the idea there's another 5 billion out there that's harder to pin down, but not much is being done about it. Do you have any broader reflections on that picture?
I think if you look at uh, the totality of New Zealand's corporate sector, then a lot of it is overseas owned. Particularly a lot of the larger companies. So a lot of those are distribution and marketing companies. There's probably less manufacturing here than there was, but that's billions and billions of dollars of revenue each year. And for example, if you simply said, well, they should be making instead of I don't know 4% return on sales, they should be making 5%. That's a lot of revenue, and that might well be the case for some of them because and in revenue say this themselves that there's a lack of competition in this market, which actually should drive up uh, um, uh, returns on sale. And I can see from looking at the accounts that are filed by a lot of overseas owned marketing and distribution companies in New Zealand, they're not making a great return on sales. So yes, there's whether that's tax evasion or simply mispricing, manipulated manipulated transfer pricing, it doesn't really matter. What matters is there's potentially a lot of revenue, a lot of tax that's not being paid.
You've mentioned that it's countries such as Singapore, Ireland, low tax regimes where the profits are ended up landing and being taxed. You've mentioned that there's effectively maybe 200 million, which we're missing out on at the moment. You've introduced some practical steps following the Australians we could put in place in the future. Is it possible for a small country like New Zealand to be taking further steps to try and minimize tax evasion, or is it something that inevitably we need to work in concert with other countries?
Ideally, we would want to work in concert with other countries. Global consensus on how to do this has been very hard to come by, still is very hard to come by. But what we can see from the filings of these global multinationals, the tech companies that we've been talking about, is that they're in dispute in a lot of countries about exactly the issues that we're talking about: payments for intellectual properties, transfer pricing, those kind of things. So we're not alone, and and it looks as though most of these other countries are, to some extent, looking at the same sort of solutions that we've been looking at, which is using existing laws if you don't have the digital services tax. Now, one of the questions that I'm often asked is, well, won't this lead to US retaliation regardless? And of course, it could do, because the US government is inherently quite unpredictable at the moment, as we all know. But there is a difference, because these are long-standing principles of source taxation. They've been around for decades. So it's not, uh, we are not using laws which have been specifically introduced to target the tech sector. So there is quite an important distinction to be made there.
Yeah, I think that's a very good point. And Kate's made a good point in the chat, which brings it back to sort of the real world and the sort of the tangible impacts. So the Better Taxes Coalition calculates for the amount of tax revenue we're potentially missing out, could pay for 10,000 extra elective surgeries, 1,400 social housing units, and reverse the government's cut of 130 million to the school lunch program, for example. So, a lot of good that could be done in the world with this potential tax. I want to give you the final word, Nick. Is there anything you'd like to leave as a leaving message, or a step that people on this webinar could be doing to advance the findings of this report?
I think certainly if people can share the report as widely as they can, because it's shining a light on this is probably the most important thing people can do, because not everyone will be aware of this. A lot of it is sort of hiding in plain sight, but you have to know where to look for it, and therefore awareness, I think, is the key point to start with, because once people are aware of what's going on, then the pressure to do something about it will mount.
Well, I think we've come to the end of the questions, and there's been a wonderful series of questions. So thanks everyone so much for participating and asking those excellent questions. Thanks everyone for attending. It's wonderful to see so many folks out over their lunch break wanting to dive into the details of tax. Thanks to Nick for your incredible research and explaining it so articulately. And for someone who's not an expert at tax, able to for me, able to try and understand what you're saying. Huge thanks to the Coalition for hosting this webinar, Kate for all her organising. There's some calls to action following this. If I could just reiterate Nick's message, please do share the report. Please do put it on social media. Sign the corporate taxes petition. Please join the Better Taxes campaign. Get involved and volunteer. Tax is going to be well, it's always a huge issue. It's going to be an even bigger issue with an election looming next year. There's a wider Tax on Tuesdays series of events, so please keep an eye out for that. They've organised some wonderful speakers around that. It's not in my sort of list of actions to do, but make a donation to them too. They're doing fantastic work, and with relying on donations and grants, it's important that citizens get involved and support this needed work.